Your credit score explained. So in today's video, we're going to take a look at three different things. First of all, why is having a high credit score important? Second, we're going to cover the 5 factors that make up your credit score. And then third, if you stick around till the end of this video, I'm going to go through a couple of different tips to help you improve your credit score. So why is having a high credit score so important? So when you rent an apartment, they're going to pull your credit report. If you want a car loan, a new credit card, personal loan, or the largest expense most people have is purchasing a home. And in most cases, people purchase a home using a mortgage. And so what I wanted to just show you the difference in interest rate and monthly payment depending on your credit score when you take out a 30-year mortgage. Okay, so here we are at myfico.com, and what you're gonna see for a $200,000 loan, as your credit score varies, your interest and monthly payment are going to change quite dramatically. So if you have a score over 760, you're going to pay 2.504%, which is a monthly payment of $791. And if you have 620 to 639, one of the lowest rates where you can generally get accepted for a mortgage, you're going to pay 4.093%, which translates into a monthly payment of $966. So what I want to do now is just show you how much of a difference in your monthly payment translates into the total interest over 30 years. So if you take $966 minus the $791, you get $175, and that's basically the difference between the highest monthly payment and the lowest. And then if you multiply that by 360, which is 12 months in the year times 30 years, you get $63,000. So here is the total difference you're going to pay in interest by having a lower credit score. So that's a ton of money on just a $200,000 mortgage, $63,000 difference. So as you can see with that, having a higher credit score makes a big difference in the interest rates you're going to get, if you're going to get approved or not. Now let's move on to the 5 factors that make up your credit score. But before we get into those, I think it's important that you have some place where you're constantly tracking your credit score. So I end up using Credit Karma with Mint.com, or probably with your bank or credit card company. They will give you a weekly update to your credit score at no additional cost. Let's get into the 5 factors that affect your credit score. The first of which, and the most important, is your payment history. So are you making payments, and are you making them on time and in full? So if you miss any payments, this can drastically affect your credit score. And I can speak, for example, that it definitely does. When I shut a business my previous business down, unfortunately, I wasn't in a great financial situation and couldn't make payments on credit cards for a number of months. And so I wanted to show you essentially the effect that can have on your credit score. So you can see here, I end up using Credit Karma to track my credit score. If we just take a look at this, so my current score is set around 710, and you see what the factors are. I'll get into the other ones in a second. Payment history right now is at 98%, which is, there were 7 late payments essentially. And so you can see if you're any lower, it's in the red, and it's gonna drastically hurt your score. Yellow is where I'm at right now. If you're at 99 or 100, you're doing much better. One thing to keep in mind here is if you're 5 or 10 or 15 days late for one of your loans or credit card payments, you may incur a late fee, but this isn't going to show up on your credit report. It's for payments that were 30 days or more late. Yes, it may incur some charge if you're a few days late, but don't worry, it's not going to show up on your credit report. And so to show you here, yep, the Capital One card is the one that I missed payments on. And so you can see here, between 2018 and 2019, there are actually 7 payments that were missed. And so this has a pretty big effect on my credit score right now. I would probably be up in the 800s or so without these missed payments. So this is by far the biggest factor for your credit score. Ideally, you're paying your credit cards off in full every single month, but at a minimum, make the minimum payment. I recommend, if you aren't sure if you can make the full payment every single month, set up on auto pay the minimum payment for your card so you don't have to think about it. You don't end up being late on your cards. It's just taken out of your checking account automatically, and you're making your payments every single month, and that'll have a big positive effect on your credit score. So the second factor is your credit card use or utilization. So this is essentially what % of the total available credit that you have are you currently using. Ideally, you want to be below 10%. That'll give you the highest potential score. If you can't stay below that, the next kind of bucket is to be below 30%. If you're much above 30%, you'll be viewed as higher risk, because if you're using a lot of your available credit, this doesn't always make total sense, because if you had a $500 available credit on a credit card and you use all of it, you would have a low credit score in that case. But if you had $50,000 of available credit and you're using $500, you could potentially go out and spend a ton of money with all the credit cards, but that's not how things work. It's basically using a lower percent of what's given to you, not necessarily what dollar amount of debt that you have on your credit cards. So to show you more from my current credit score, so right now I'm using 15% of the available credit that I have, which is clearly in the green section according to Credit Karma. Like I said before, if you're between 30 and 50%, you're in the yellow. And then it's red if you're above 50%. And so I've seen my score jump up quite a bit if I get below 10%. But right now I'm not trying to apply for any new mortgage, car loan, or anything else. So I'm kind of comfortable the fact that, I have this one credit card that actually is above 50% right now, which is kind of hurting my credit score. But the thing is, it's at 0%. If I needed to get a new loan, I could pay this down and I would see my credit score jump up pretty significantly by making a payment on that particular card. So the important thing is try to not use too much of any one of your cards and keep your overall credit card utilization as low as possible. Now moving on to the third factor, which makes up 15% of your score, is the age of your credit. So this is the most recent credit you've taken out, the one you've had the longest, the average, all of that is made up as part of this score. So the important thing is the longer your credit history, the better. So as a really simple example, let's say you have had one credit card for 5 years and one credit card for 1 year. The average right now is 3 years. So if you were to close the card that's 5 years old, then all of a sudden it would drop the average age of your credit down to 1 year. So the important thing here is, especially for your credit cards, if there's no annual fee, to not close the cards, and over time you'll see the average age of your credit increase. Because imagine if you get a car loan or a personal loan for a couple of years, you have that for a few years, like say 5 years, and then you pay it off and then that drops off. Where if you have a credit card, especially with no annual fee, that you just never close, you're gonna see over time the average age of your credit gets older, which is going to improve your credit score. You can see for mine right now, the average is 9.4 years. And so I have some student loans from when I graduated from Michigan State in 2004. So I think the first part of the loan may have been taken out several years prior to that. And then some from my MBA from 2009 to 11. And then I've had, several credit cards and other things for a long period of time as well, which has helped extend the average age of the credit that I currently have. So factor 4, which is 10% of your score, is the types of credit or your credit mix. So the total number of accounts that you've ever had, you currently have open, the mix of types of credit you're using. So ideally there's a mix of credit cards and loans. So I think maybe the highest potential score is if you had a car loan, a mortgage, student loans, credit cards. But look, this is 10% of your score. And so you can see I have a couple of dings on my credit report right now and have a score in the 700s. I have student loans and credit cards right now. I wouldn't just add types of credit to try to get a couple of extra points here. And so if you don't need a car loan and you can pay cash for your car, don't take out a new type of credit. So what you can see here from Credit Karma is from 0 to 5 accounts is the worst, from 6 to 10 is still in the red, 11 to 20 is green, and above 21 is the best potential category. I mean, I wouldn't say just go open a bunch of new accounts and different types to try to bump this up. Maybe you could use an extra credit card with no annual fee to help you here and with the payments and utilization, but I wouldn't stress about this category. Category number 5, which is also 10% of your overall score, is the new credit, if you have applied for new credit recently. And so this is something where the less applications, the better. So what'll happen is if you apply for a new credit card today, they do a hard pull on your credit. You may see your score drop by a couple of points. I've seen kind of 2 points when I generally apply for something. And then usually a few months later, it kind of returns. The thing is here is I wouldn't go apply to 10 credit cards and a bunch of different types of credit. If you're doing stuff periodically, once or twice a year or something like that, I wouldn't stress out too much with this. One of the things, like if you apply for a new credit card, if you think of like the cause and effect and what happens over time. So if I apply for a new credit card, which I did a little over a month ago, I may have seen my score drop slightly, but what'll happen is all of a sudden I have $9,000 of additional available credit. And so all of the other metrics, the utilization plus another on-time payment every month, those will be positive factors to my credit score, where there was a kind of a short-term ding to this category because I applied to one new credit card. So this one area, I wouldn't stress too much. Just don't go crazy applying for tons of stuff, especially all at the same time. So now let's move on to some tips to improving your credit score. So one tip that can make a huge difference if you have poor credit and you're trying to rebuild, or you essentially have no current credit, is called credit card piggybacking. So that's essentially where you are added as an authorized user on someone else's credit card. And so that's one thing that I did when I had the problems with my credit card debt, being added on someone else's card, especially if they're not using that card at all. It's somebody you trust. So you may have thousands of available credit from this one card. Also, the payment history of on-time payments helps. And if they're basically not using that credit card, that's helping lower your utilization and rate. So if there's someone you trust that you could ask to be an authorized user, you could get some additional payment history and additional available credit. They don't have to give you the credit card. So they just add you as an authorized user. They don't have to actually send you the card. And it's something that can greatly improve your score, or at least give you a little bit of a bump if you have no credit history, or maybe you had some credit problems. The second way to potentially bump your credit score a little bit is to open a secure credit card. So if you have, again, no credit file, or kind of have had some problems, you can open a secure credit card, which basically you make a deposit and then they give you that deposit back in available credit. And the nice thing with this is you're getting those on-time payments if you're making on-time payments for that new credit card. Also with this, make sure you're paying everything in full on time so you're not being charged interest for the new credit card. But if you had some credit problems and you're looking to rebuild your credit, starting off with a secured card, one of the things to make sure is there's no annual fee. Some of the credit cards you can get some rewards or cash back with. And take a look at how soon they will review your credit. So I've seen, I think Capital One will review your credit history after 6 months, where I think Citibank is 18 months. So potentially with Capital One, 6 months after that deposit, you could get the deposit back and still have a credit card with that amount or more that you can use, where Citibank isn't going to review that and potentially give you your money back for 18 months. The next tip is understanding when your credit card company sends your balance to the credit bureaus. So there's some gurus that are like, make payments twice a month because that'll help, but that's not actually what it is. So to kind of explain this a little bit, so imagine you spend $1,000 every month. And so what happens is, so on September 1st, you get your statement for $1,000. Then all the way through September, you spend $1,000 as well, and then you made your $1,000 payment on, say, September 25th. And then on October 1st, you essentially have $1,000 statement balance again. So it's that October 1st date of having $1,000 balance is the number that gets sent to the credit bureaus. And so what'll happen is throughout the month before you made your payment, maybe your total balance was $1,800 on September 25th. You paid $1,000, it dropped down to $800, and then from the 25th to the 1st, you spent another $200 that got you to $1,000. So what could happen is basically from the 25th to the 1st, what you spend and what the balance is during that, like that day when the statement comes out, is the number that gets sent to the credit bureau. So if you could make an extra payment before the statement comes out, it'll lower the statement balance, and that means the utilization rates are going to come down on your credit cards. So this could be something where you're making the payments in full on your cards, but you're still seeing that your credit score isn't that great. It could be that you have a high utilization of your cards each month. It's not necessarily a bad thing as like you're not being charged interest, but the fact that the utilization is a little bit high if you made the payment right before the statement came out. So you'll see you'll improve your score quite a bit because the utilization rates will come down by making a payment right before the statement comes out. This next tip is for business owners. I'll link to a video up above right here where we took a look at if having a business credit card can help or hurt your personal credit score. In my case, it helped because previously I was using my personal card for business expenses, which bumped up my utilization rate, which hurt my credit score. You could see from earlier in the video that that is 30% of your score. By opening business credit cards, I was able to move those expenses to those cards. There was a short-term hit basically by the new credit part of your credit score where they would check my credit score. But the thing is, that may give me a ding of 2 points, but then I was able to take several $1,000s that I had in balance from my personal cards, and now those are on my credit cards, which dramatically lowered my utilization, improving my score. So if you're currently using your personal cards for business expenses, try to separate the two and it'll help you improve your score. The next tip is if you're looking to apply for some new loan, so student loans, mortgage, car loan, you want to try to do that in a short time frame. Because what will happen is the credit bureaus look at it basically as one hard pull of your credit report. Because basically they're saying, hey, this person is out rate shopping. This doesn't count if you apply for 5 credit cards at the same time, but if you go apply to several different mortgage companies to see which one will give you the lower rate. So I think the old way of looking at it was within 2 weeks, and I think they've extended that now to 45 days. But just know if you're going to be out rate shopping, to try to do that in as short of time frame as possible so that the credit bureaus only count that basically as checking your credit once. So the next tip is something I mentioned earlier on in the video. Is important to have at least one, maybe more, no annual fee credit cards. You can have annual fee credit cards if you're spending enough money where you're getting more back in rewards than the annual fee. But the reason for having one or more no annual fee credit cards is there's basically no reason to close them, and there's a bunch of benefits for your credit score. You're getting additional on-time payments for them. You have additional available credit help, the utilization, and then you're helping with the average age of your debt. If you have a credit card with no annual fee that you hardly use, that you've had open for 10 or 20 years, it's helping the average age of your debt, bumping up your score. All right, so if you want to learn more about credit cards, we have a bunch of videos that help you with that. I'll link to those right here. If you want to learn more about how to improve your credit score, check out the playlist below. Hope to see you in those and future videos. Bye-bye.